Right here. So Bitcoin, obviously, best performing asset of all time. If you were lucky enough or clever enough to buy it in 2015, 16, you made ridiculous amounts of money. But now, that being said, what do we think about it from here? And the truth is, it has been around long enough, and it's kind of stood the test of enough time now to say, this thing is going to be here to stay, right? It's experienced multiple downturns and it's recovered from them. It's shown some resilience in the face of crisis, right? So you had the liquidation move in March. Again, every asset class got smoked. Bitcoin, no exception. It went down by 40% in a day. Okay, now people make that a reason that you can't buy this thing because it's done that. But the truth is, you had equities dropping 12% in a day, right? And we all know that Bitcoin on an average day is at least 4 times as volatile as equities. So it's just completely in line with the equity move, really, if you think about it. So that's not really a reason to shun Bitcoin. But anyway, I think the resilience that it's shown, I think a lot of the drivers of it are similar to that of gold. So if you're uber bullish on gold because of fiat currency debasement, and you don't really see how the nominal price of gold can't go up. It has to go up in the face of all this money printing, trillions and trillions that have been printed in response to the crisis and are going to keep being printed, to be fair, is the rational expectation. So Paul Tudor Jones's report that he wrote, it's called The Great Monetary Inflation. Breaks it down really, really well. Analysed a bunch of inflation hedges, talking about that the consequence of all of this central bank and fiscal action is just the debasement of money, and what can you put in your portfolio to protect you against that. He lists a whole bunch of stuff. He kind of ranks them, analyses them, does a really decent analysis. But ultimately, what he's saying is, Bitcoin has a place in that portfolio as a hedge to a lot of this inflation that we are going to see, right? This monetary debasing. And as a store of value, he makes the point that what is a store of value? How do you define a store of value? And the things that a store of value needs to have, the characteristics need to be maintaining purchasing power over time, trustworthiness, liquidity, so ability to transact, and portability. So can you move it across borders and stuff like that? I mean, Bitcoin, stacks up pretty well on a lot of those measures. So I encourage you to read the report, have a think about it, and we're not talking about putting all your money in Bitcoin, right? Whoever does that is a bit crazy. But putting up to 5% of your kind of liquid assets or whatever portfolio you're managing, putting up to 5% of it in Bitcoin, and thinking of it as a call option that can go to zero, but can also multiply by 10 in the next 10 years. Probably 10 years. I mean, it's only I think you do a lot more than that, right? So it's a call option that doesn't pay decay. And trust me, as an options trader, that's the most beautiful thing, to be long an option that can multiply many, many, many times over and doesn't experience any time decay. Pretty good place to be. And it's a hedge. It's a hedge to the irresponsible actions of policymakers around the world that back themselves into a corner where there is no feasible way out other than to print. I mean, if you look at the chart on Bitcoin, and I've zoomed out here, right? So 5-year chart on Bitcoin, we obviously had the explosive move in 2017, massive correction in 18, which washed out all of the crazy mania. Then you had a nice rally again in middle of last year, and we're consolidating, chopping. We had this liquidation move in March. Let's call that an anomaly, right? Because every other asset's had it as well. We could just say, we're now back into this sort of chop here. I think if we break up here above, say, if you break above 11,000, then, you start to think, okay, maybe the next move is on, right? And the next move could easily, it's a log scale, but the next real move, and, for Bitcoin, 6 months, it could do a real move in 6 months, right? So for Bitcoin, a 6-month move, if we were to break through 11,000, could easily take us back to the highs, if not higher, right? So that potential is clearly there. I mean, if you look at the options market in Bitcoin, and that has actually matured a lot over the last couple of years. And I can show you quickly here. Deribit is the exchange. You can trade options on Bitcoin. That's what I'm doing. Obviously, being an options trader, I want to trade options on everything. So I've started trading options on Bitcoin, and there's some good resources on Twitter and things like that you can find that will tell you about the setup in the options market, how the volatility curve looks, where the flows have been, where the open interests are. So apparently there's been a fair amount of call buying, short-dated call buying in the kind of. In fact, I can show you. There's a site called Skew.com. It's actually set up by some ex-traders in the equity space who I had the pleasure of working with. One of them, he set up this site. Skew, it gives you analytics for Bitcoin futures, Bitcoin options. It shows you all sorts of stuff. Here you've got the term structure of volatility for Bitcoin, so you can see where short-dated volatility trades at 58. September trades at 70, so you can get an idea of the shape of the curve. You can look at where the open interest lies. So here we can see Bitcoin options. There's lots of open interest in the sort of 11,000 to 14,000 area. There's been a lot of open interest, right? So you can see there, and that would be call buying probably in that area. So people have piled into short-dated calls in that area, right? So if we start to get a move up in Bitcoin above 11,000, then you might get a bit of a scramble from people who are short those calls to come in and buy that stuff, right? So there's lots of interesting stuff in the Bitcoin space. You can trade options. If you're not comfortable just like buying Bitcoin knowing it can go to zero, then you can buy some call options on Bitcoin, right? And this is a place to do it. Deribit. So I've started trading on this about a month ago. I've got my own kind of strategy where I basically am kind of underwriting the market where I sell puts on Bitcoin, with a view that if it goes down and if it goes through my put strike, I'm happy to buy that amount of Bitcoin at that price and just continue accumulating Bitcoin. So my plan over the next sort of 3 to 6 months is to accumulate whatever amount I'm comfortable sort of parking in Bitcoin over the long term. And I'm doing it via this kind of put selling strategy. So I'm benefiting from the fact that I'm selling implied vol and I'm earning time decay, and I'm using that as a systematic way to get long Bitcoin. And that's pretty much it. So that's my update. So equity. Oh, one last thing I would say. Obviously we've had this massive retail-driven rally in equities, more than any of us could have really imagined. Has the economy really changed? Has the outlook for the economy really changed? If we get no second wave of the virus, and magically everyone gets herd immunity, then sure, why not, right? We can say the bad stuff is over, the rally was justified, and we're going to get a big recovery sort of for the rest of the year and into next year, right? But that's what the market is pricing. The market is pretty much fully pricing that there's no chance of a second wave, there's no further lockdowns coming. Earnings are going to recover. We know Q2 was a disaster, but Q3, Q4 is going to be a strong recovery. Next year is going to be a strong recovery. Vaccine's going to be done by the end of the year. Everything's back to normal. There's going to be no long-lasting effects on people's behaviours. It seems a little bit far-fetched and a little bit optimistic to me, right? So I think the market is up here because retailers, basically retail people, and I don't really understand the psyche here, but apparently people have been sitting at home getting unemployment checks from the US government, and in the face of not having a job, they've decided to go and set up a Robinhood brokerage account and pile all their cash into FANG stocks, airline stocks, and oil stocks, right? Or oil ETFs. Now, is that something I would do if I just lost my job? Probably not, right? But having said that, the guys who have done that have doubled or tripled their money. So fair play to them, right? They should probably take their money and run for the hills, because generally when retail is the marginal buyer and all the institutional and smart money is getting the hell out, that usually ends badly for retail. So I am anticipating over the next month we're going to see more and more news of second waves, particularly in the US, where there's been a lot of protests going on racial protests, and I think that just continues as we go towards the election. And obviously lockdowns are getting lifted anyway, so more and more people are going to get together. I just find it pretty hard to believe we're not going to get significant second waves, and we're not going to get more speculation of second lockdowns, and the reality of the recovery not being so plain sailing is going to start to set in. How's that going to manifest in markets? Remains to be seen, right? But I would anticipate maybe a 20% sell off in equities, but the way these tech stocks behave, who knows, right? But like I say, I think the Russell's the place to be if you want to be short. Russell's easily got a 20% sell off in it as reality sets in. I would argue Russell could go back to its lows. Do I think the S&P is going to go back to its lows? It's possible, but I would also say it might not manage to get below 2,600, right? And we've seen the reaction function of the Fed. We know that the Fed is desperate for the equity market to be up, and they will do the minute they see a whiff of a second wave and a second panic in the markets, they're going to come out guns blazing again, right, to try and get the market back up. So I think you've got to be cognizant of that. You've got to be wary of that. But buying the equity market up here at these levels and these valuations, in the face of probably marginally bad news to come, given all the good news is probably in the price. Yeah, I wouldn't be touching equities up here. Right, I'd certainly be, and as a tactical trader, I think, it's not a bad entry to start putting some shorts on again. Yeah, the move from 28 to here, 2,800 to 3,200 on the S&P, it was, that squeeze risk was clear, right? The pain trade was to the upside. I stopped shorting it for that reason. I now think it might be safe to bring the shorts out again. Yeah, and that's what I'd be looking to do. I know I sound like an uber bear, and I'm only ever talking about the short side. Truth is, I'm happy to buy markets when there's actually a good fundamental reason to buy them. But we are potentially facing a depression like we haven't seen since the 1930s. And in the face of that, I struggle to get on board with the buying, right? So, that's my personal bias. You might disagree with me, but that's it. So, I think gold still's got upside. Bitcoin's got ridiculous upside. Equities tactically probably needs to have a pullback. In the face of a 20% pullback, maybe I'll buy call options on equities again, right? Because we know what the Fed's going to do, and we know where the Fed wants equities to ultimately go, right? So that's kind of how I would trade it. Bond market, I'm not so clear on. Most likely bond market rallies. Certainly in the face of equity weakness, bond market does probably rally. But the ultimate resolution of all of this is inflation, right? And in the face of inflation, you don't want to be sitting on too many bonds, right? So that's my quick and dirty market outlook. I hope it was useful. And good luck trading. Thanks a lot.